Assalamualaikum, my name is Muhammad Nur Hazib bin Hulidan and my matrix number is 068223F1062. Today I would like to present problem case for case 3. Case 3 is about company A, a long-term client with annual fees of Rm50,000 to the firm, have a client that went into receivership and went into a large debt. The company needed to pay Rm25,000 more to the firm, but it is a potential independence threat to the auditor. The ethical problem that arises in this case is when the company owes Rm50,000 to the firm, which is allowed to defer payment over 10 months. Company A is facing financial difficulties, which will end the going concern of the company, and in needs of the bank assistance, which has to provide an audited financial statement of company A by the bank for them to give an assistance. The audit was performed by the audit senior and reviewed by audit manager, which did not know that the company A owes the firm Rm25,000. This situation could violate relevant MIA bylaws such as integrity, objectivity, and professional competence and due care. Due to knowing the firm is owed significant overdue fees, which may influence the auditor to hide the fees to make sure the company survives to pay the fees owed to the firm. This also creates a self-interest threat and a familiarity threat, due to the company owing Rm25,000 to the firm and company A working with the firm for 5 years. The affected parties. The three main affected parties in this case are accounting firm, audit partner, and company A. The accounting firm independence and reputation are at risk due to the company A owning the firm 25,000, which creates a self-interest threat if the firm continues to audit the company. As a partner in the accounting firm, it could damage the integrity and reputation as an accountant and may end your career due to violating the professional conduct of MIA bylaw. Company A is also affected due to the firm receiving a compromised audit financial statement that could mislead the company health and broke the professional competence and due care due to not checking the audit plan in detail and signing off the section of audit file. The solution for case 3. The first solution is to request immediate settlement of outstanding fees. The firm can request company A to pay the outstanding fees before continuing the audit, which can remove the self-interest threat and allow the firm to continue the audit, but could also delay the financial statement due to company A may not have the fund to pay the firm due to the large debt. The second solution is to withdraw from the engagement. The firm can withdraw from auditing company A to be safe and not damage the firm's reputation in the accounting field and maintain independence, but company A may have a negative reaction and the firm will lose a major client. The best solution, in my opinion, for case 3 is to withdraw from auditing the financial statement due to company A being in a receivership situation and may not be able to pay the outstanding fees of Rm25,000 to the firm. This solution protects the firm's reputation as well as the credibility of the partners in the firm and prevent disciplinary action or legal consequences by eliminating the risk of violating the MIA bylaw and professional ethics. The fundamental principle that feature more prominently for safeguarding in case 3 is objectivity. This is because objectivity requires auditor to avoid bias, conflict of interest, and undue influence that could override the professional judgment of auditor. In case 3, company A still owes the firm Rm25,000, which could influence the firm and the auditor to issue a favorable opinion in audited financial statement to help company A comply with going concern, which means company A will eventually pay back the loan that is owed. This violates objectivity because it means the auditor was biased toward company A. My key consideration in solving these dilemmas are to see if the firm can maintain independence and objectivity when company A still owes Rm25,000. If the firms cannot maintain the objectivity, they should withdraw from auditing company A. Ethical threats should also be evaluated to see if there is Ethical threat should also be evaluated to see if there is any threat to an auditor, such as self-interest threat and familiarity threat due to company A owing money and the firm knowing the company A for 5 years. This dilemma can be resolved by having the audit partner reassess the firm's independence, as the unpaid RM25,000 create a self-interest threat under the MIA bylaw. The partner must communicate openly with company A, explaining that the audit opinion cannot be issued until independence is safeguarded. The firm should request payment of the astounding fees or arrange a payment plan. If independence cannot be maintained, the firm must withdraw from the engagement. This course of action upholds the fundamental principle of objectivity, integrity, and professional behavior and due care, ensuring compliance with MIA ethical requirement and protecting public confidence in the audit profession. That's all from my presentation of case 3. Thank you.